This is a video to act in accompaniment with this investing document, Momentum Investing. This presentation will discuss various concepts discussed in the document. Hopefully, it will be a little bit easier to understand or interpret than the whole document. Basically, when you're talking about a stock's movement and whether or not you can anticipate the price of the stock going up, you're talking about short-term trends and long-term trends. I'm looking at the weekly chart right now. And so when I'm looking at the chart, if I zoom out, I can kind of see this is Walmart. I can kind of see what looks to be, and you could draw a trend here from, at least 2015, late 2015, of consistent uptrend. Yet if I zoom in, or better yet, if I look at a shorter chart, I get a lot different picture. And so one of the big takeaways that I would hope anyone should look at is that when you're looking at the direction of a stock or a security or whatever, you need to think about it in terms of trend, right? One of the reasons why financial advisors recommend just putting money in an index fund and leaving it there is because in the past, over time, if you're just patient enough, the value of a stock or a fund or whatever will go up. So, for instance, if I look at the Dow 30 and I zoom out to the monthly chart, I can see that even though there are periods of flux, periods of volatility, the trend is pretty consistent. I mean, this is back to 2002, but we can zoom out to the yearly chart and see that you get really parabolic from the the early 90s until 2000, and then you get a correction, and you're basically getting pretty remarkable uptrends since then. So, of course, if you're a student of history, you know that a lot of this has been driven by low interest rates. But regardless, I think what you have is a situation where, at least historically, you can rely on the stock market to trend up over time. However, if you try to hack the market more than that, you'll notice that sometimes the short charts don't agree with the long charts. And that stands to reason. There's always volatility in any investment. But one of the questions that I've had for a long time is, how can I hack this? How can I take advantage of this volatility to gain returns that are greater than just leaving money in a mutual fund or something like that? And so what I describe in this document are a series of indicators that I think are helpful in doing that if you have the patience and are willing to do it properly. There's a lot of ways to do this wrong and fewer ways to do it right, frankly. And honestly, one of my big takeaways over the past, say, 6 months is that patience still matters. And the concern for the long-term trend is really kind of front and center in this. So that's what I'm going to talk about here today. So if we go back to Walmart, we can see, if we zoom back out to the weekly chart, and I always start with the weekly chart because that is sort of the most realistic sort of human time frame to think about. It's like, well, if something's not going the way I hoped it would, well, I can wait it out a few weeks and hopefully it turns around. So what you can see is that since 2015, we can draw a linear line here if we were so inclined to demonstrate that you basically have this trend, and there are periods where we are above the trend and periods where we are below, but on average we are following the trend. And you can see that the trend before that, for almost a year before that, was down. But then we broke the trend and we started moving up. So one of the things that I talk about in the document, and I think front and center in the concern, is the price percent oscillator crossover. And so what you get is this blue line here. It's this thick blue line. And it runs in combination with this red line. And so if you'll notice that when the blue line crosses the red line from below, that tends to be correlated quite strongly with up movement. And when it crosses from above to below, you get some down movement. You get correlation with down movement. And the strength of the correlation isn't as important as the fact that there is a consistent correlation. So what's going on here is that this is just sort of taking advantage of something that investors have noticed for a long time, is that if you have a stock, it has a daily price, and you can compare it to a rolling average or a simple moving average, say a 20-day moving average or a 50-day moving average or 200 or whatever you want to do. And when the price crosses the simple moving average, that tends to be bullish, which means that the stock price is going to go up. When the price crosses below the simple moving average, that tends to be bearish, or the price goes down. So in this case, what the price percent oscillator and this red line, which we call the signal line, it's an exponential moving average, so a lot like a simple moving average, just a little more complicated. This is basically a very similar thing. If you look at the math, basically the price percent oscillator and exponential moving average are smoothing averages. That's the best way I can describe them. If you look at how the math is done on the price percent oscillator and signal line, it's basically a function of a rolling moving average. So in the case of the price percent oscillator, it's a function of another smoothed function called the MACD. The MACD is basically the difference between two moving averages. So it's a lot of math, it's a lot of technical nitty-gritty, but the basic idea of most of what I look at is that you're smoothing out averages to get to detect trend. And as it turns out, some stocks are really good at signaling that they're going to have a trend, and some stocks are not so good. The stocks that are really good tend to be large cap, big company stocks, and some ETFs. What you're looking for is high volume. If the volume is high and the price of the stock is high, then it seems to me, at least in my experience, that what you have is you have more consistency in terms of these crossovers and indication of direction. So you can see when it crossed over here, price went up. It went from the high 60s to a peak of 80. So that's in from February to June. So in 4 months, you get about a 30% return. That's not bad. Most people are happy with a 10, 12, 15% return. A 15% return, if you did that every year, you could retire pretty young if you have enough money to start with. So one of the things that I would point out is I go into kind of comparing weekly charts with shorter charts in the document. But one of my big takeaways lately has been, you've got to catch this weekly crossover early. If you don't catch the weekly crossover early, you're not really going to have as much of a guarantee of results. And in fact, a lot of people, they could simply just buy at the bullish crossover, sell at the bearish crossover, and have a pretty good day. A pretty good investing career. But one of the things I talk about in the document is, well, what if we kind of hack this, where it's like, well, even within a weekly crossover, you're going to have bearish events. You're going to have bear days. Is there a way to kind of hack that even more? And so in the document, I describe, well, let's look at the 2-day. So like if you buy on the weekly bullish crossover and say sell on the 2-day bearish crossover, that's a way to sort of optimize even more. And of course you can do that, and I certainly do that. But if you're not catching it early in the weekly crossover, at least in my experience over the last few months, I just have not had very good luck, because you're in this case, they'd been crossed over for over a month before they had their big move. But that's not always guaranteed. I mean, there's other factors as well to consider that I think can kind of guide success. But the big one, I think, at least in my mind, is catching the weekly crossover early. So just to let's walk through an example, and I'll leave it be after a while, but I just kind of want to demonstrate this here. So we get the crossover here. I think, yeah, because you can see when I highlight here in the lower part of this pop-up, it says price percent oscillator 0.6, exponential moving average 0.74. So we haven't had a crossover yet, even though these green bars, this derivative oscillator, has gone positive. But we get the crossover here. It confirms at the price 97.82. The next week it's 101.19, 98.82, 97.97. So this hasn't been all that interesting of a crossover as of yet. Probably because Walmart and other retailers are pretty cyclical. So you might get some crossovers are going to be better than others. So this one was in the summer months. So retailers tend to get busier and busier in the second half of the year, and obviously they go black. I mean, I assume that Walmart's black more of the year than most retailers, but retailers start to go black after November. But in this case, we get the crossover here. It confirms on February 15th, so the time to buy was not until maybe really, really close to end of day on February 15th or the Monday morning after. And I recommend, unless price drops right away on Monday, wait until later in the day on Monday to buy, maybe until after 10 a.m. Central Time, which would be 11 Eastern. So we get the crossover. Not a terribly compelling crossover. You get a few percent. I mean, if you're happy kind of scalping, so we opened the next week at 96.53, peaked out at 104. It closed that next week at 101. But if I bring it down to the 2-day here, I can see we get kind of simultaneous 2-day bullishness at the same time that the weekly crosses over. And I can see that there is, we get the peak in the 2-day. You can see that we get a bearish crossover on the 2-day not long after. But we peak out at 104. So let me go down to the 4-hour and show you what I'm getting at here. So this is the crossover, and you can see that it's basically on Tuesday that we get that peak. And later in the day on Tuesday, we try again on the 4-hour, and and it looks like it's starting to fail. And you can see that on the candle here, this is a Heikin-Ashi candle, which is another smoothing function candle. So it's not like a regular candle. There's an equation that I describe in the document. Let's see if we can find it here. Heikin-Ashi candles. So you can see there's each, where the traditional candle has open, close, low, high. Heikin-Ashi candles are sort of smoothed out a little more. And so that's very useful because when you're in a bullish movement, the subsequent candle is going to open right in the middle. And so what that means, at least in my mind, is that if the price drops below that middle value, that is a sign that you're running out of bullishness. So this is where a 4-hour, drilling down into shorter charts really comes in handy, because there's two things that I consider with these Heikin-Ashi candles. One, does the price go below this midpoint? That's bearish. Two, does the high price of the current candle exceed the high price of the previous candle? And you can see that it doesn't. And you can see that the close price was below too. So in the document, I recommend when you have this happening, regardless of the chart you're using, this is a sell signal right here, at least in my mind. I mean, some people might wait for this red candle. When it's filled, that means it closed below what it opened at. And in Heikin-Ashi, it means something just a little bit different than that. But this is the signal to sell, in my mind, is that neither the last price exceeded the last price of the previous one, and the high was lower than the previous high. Sell. That's it. And so you're out between maybe 101 and 103, depending on, how your particular strategy. But, if you buy in the, high 90s, you've made a nice little profit in a couple days. So that's that. I think that the combination of, looking at the charts, contrasting the charts, right? The weekly chart is in an uptrend, but the shorter chart is showing a bearish signal. You can take advantage of that. I've kind of gotten to the point where I'm doing this 4-hour less because I'm happy not being so active. I feel like if you catch a weekly crossover early, if you do it frequently enough, and maybe you trade on the 2-day instead of the 4-hour, it depends. I think that if you got like 50% return in a short amount of time, to me, I'm looking at that like a hot potato. I'm getting out. Maybe I'm not selling all of it, but I'm selling a good chunk of it because I want to secure that profit. And my goal is to make a profit, not to stroke my ego or be overly sentimental about the prospects of a particular stock. But you can see that you did get on the 4-hour a bearish crossover, and that was followed by sideways downward action, sideways and downward. And then recently, it looks like on Tuesday the 12th at noon, we had a bullish crossover again. I kind of like those midday crossovers. I don't like it. I tend to be a little bit apprehensive when the crossover occurs at the end of the day. And that just means that I tend to wait, because it can pop the next morning or it can go way down the next morning. And that's because algorithms are looking at these data too, or similar data, or data that's correlated to them. So one of the things that I would point out as well, since we're looking at this chart, is that these Bollinger Bands, and by the way, my Bollinger Bands are a little bit different than most people's. I think most people use a different period, a different standard deviation on their Bollinger Bands. I'm not trying to do anything tricky. by doing my Bollinger Bands. I just like it to be obvious, and sometimes it's not so obvious when you're looking um, at the standard view of Bollinger Bands. But basically, the idea of Bollinger Bands is it's just another smoothing average. I think it probably uses a confidence interval or something like that. I've never really looked at the math. I don't care enough to figure out how Bollinger Bands work. They they're not my primary indicator. I just find them useful sometimes. But when you get this narrowing, this is called a Bollinger squeeze, right? So you get this narrowing, and then they come apart again. And so depending on other attributes of the stock, um, this squeeze can be bullish or bearish. It just means that volatility is upcoming. So I'm going to use my price percent oscillator and candles to sort of play that. But you can see here again that corresponding with this crossover, you get this Bollinger squeeze again, and I really like that. I think that Walmart will probably move up here. I don't know if it's going to be huge because we're just not in hot retail season right now in March. But it could be. It depends. I think a lot of times these charts follow buzz. Like there's buzz about a company, there's some news that everybody kind of expects to be coming, and so price moves kind of in accordance with that while everyone's kind of doing their own game theory stuff. But ultimately, um, stocks, at least in the long term, tend to follow valuation. Like if a company is worth a lot of money, people are going to invest in it, and if they're not, they're not. So, but in this case, I see this as a bullish signal. You get this 4-hour crossover. It's within the weekly up movement. The weekly up movement had gone a little stale here, but it looks like it's at least going to try again. Who knows what's going to happen? But I think that it's probably got a few days, and if you buy on this 4-hour crossover here, with the understanding that the weekly is looking good in terms of has confirmed crossover. In this case, this might be a little bit of a reason to be apprehensive, is that the 2-day is still bearish. But I found that I've had success both ways. But in this case, you might buy, at the crossover. The crossover, it ended at 98.44. It opened at 98.23. So you're buying in the low 98s. What you can do using that candle theory is that you can set a stop loss order, right? So the price here, the bottom price, which is the halfway point between the previous candle, was 98.02. So if you set a stop loss for, say, the mid 97s, I usually do the previous candle, the bottom of it, and then I give it a little padding too, just to account for volatility. Although highly traded stocks are a little bit less volatile than other stocks, but you set a stop loss for, say, 97.50, you buy it at 98. 98.20 or something like that. Basically, you've limited your downside, and your upside is whatever you kind of anticipate it to be. So here we've been bumping into a historical resistance in the low 100s. So this stock may not have been a great buy at this point, just because it's been bumping into historical resistance and it's been kind of failing here. So maybe not the perfect stock to buy, but you could probably scalp a couple percent profits here, and at the very least you limit your downside quite a lot, and you're buying a company that is going to be in business a long time. So that is that's kind of another approach, using the Bollinger Bands in combination with the price percent oscillator crossover. One thing I mentioned a little earlier was these derivative oscillator lines. This derivative oscillator is It's I think similarly a function of this exponential moving average that so many other things are a function of. When it goes positive, that is when these bars are green. That's bullish. And when they start getting shorter, when they start approaching this zero, that's bearish. So it's kind of a tightrope you're walking with trying to decide what the sell point is. But in my mind, if you kind of play with this idea where you buy based on the bigger chart and you sell based on the shorter chart, and you watch these, these for crossovers or candlestick just failures, I would call them. That's a pretty good starting point. One of the things I mentioned in the document as well is that in these Bollinger Bands, at least in this view, and I don't really see this in a lot of other stock charts, which is one of the reasons why I like free stock charts, even though it's very imperfect in a lot of ways, is that it's got this line in the middle, this dashed line, and I think that it's some kind of exponential moving average as well. But what I find is that when the candles are significantly, at least above the dashed line, that's more bullish than when they're below. Now, that's not always the case, but I find that it to be a really good starting point. When the price goes above this dashed line, especially when there's other bullish signals in the chart, that's very bullish. So that's one of the reasons why Walmart kind of popped out to me. That it may not be a huge return on this particular stock right now, but I think that in general, you've got some safety in going here, especially if the market's not looking great. You try to make better choices and safer choices. So that's kind of the gist of what I would argue for here. Let's look at another example, and we'll see if we can't find a better example of up movement. I invest in a lot of ETFs, exchange traded funds. I like the leveraged ones because you kind of expose yourself to a little bit of risk, but there's a lot of opportunities and rewards as well. And if you've kind of got your finger on the pulse of the market, if the overall trend is bullish or bearish. And so I can buy a bullish ETF or a bearish ETF, depending on what's happening. As of late, you can see just by glancing here, all these bear funds were down yesterday. And so that means, well, it's probably a bullish time, at least in the short term. So let's look at this this TNA. This is a small cap ETF. It's a 3X, so it's a leveraged fund. You can see here that we had this crossover on January 25th. It was at 54.12. We peaked out at 67.96. So, I mean, you're really talking less than 2 months, and you get, gosh, what is that? So 55, 67, you're talking about a 20% return in 6 weeks. That's not bad in my book, right? But again, we're starting with the weekly chart. It's important to catch it on the weekly crossover if you can. So we get the crossover here. And then if we look at the 2-day, you can kind of see that. So this is where the crossover is occurring. So on the 2-day, we're kind of going sideways a little bit, but we're looking good on the 2-day still. We're still bullish on both the derivative oscillator and the PPO. We go to the 4-hour, and let's see if we can zoom back. But you can see here, when the weekly chart crossed over, the 4-hour chart was still bearish. So in my mind anyway, what you can do is you can watch for this event, right? The long-term chart is signaling that it's about to get more bullish, and yet the short-term chart is still bearish. So the way you hack that is you just kind of follow the 4-hour chart or the daily chart if you want, but I kind of like the 4-hour chart because it allows me to look intraday, and it's not so short that it's not useful. So I can buy, if I'm sensing, and you can see that the price is starting to go up here as these derivative oscillator bars start to get closer to zero. So we're actually approaching, so the weekly crossover is in the mid 55s. And so we're below 55 for quite a while on the 4-hour, and then we kind of pop into 57, right? So the 4-hour chart starts to come alive, while the weekly chart is still going, while the weekly chart has been bullish this whole time. So if you've got the stomach for it, you can hold through the 4-hour pullback here, because this would have been kind of an uncomfortable time, right? You bought it, say $57, you get this 4-hour crossover, and you can see that there are points where you're underwater, it's in the 56s. But if you hold out, you would have had this huge return here, from the 56 to the high 60s, right? That's beautiful. But the trouble is that you've got a lot of volatility at this time. So it just depends on what kind of investor you are, how much you're willing to hold. A lot of people look at these 3x ETFs and look at them like hot potatoes. You kind of just jump out when you've gotten a decent profit, and you jump back in when the crossover occurs. It's up to you. I mean, in reality, this is over the weekend that this happens, but it's only a couple days that you got to kind of have the guts to deal with it. My own perspective is I'm starting to look more and more at or less and less at the 4-hour and just following the 2-day. But, if I follow the 2-day, there was never really a time to sell here until let's see. Well, it might have been right here, but this is probably the same time that the 4-hour was signaling as well. But you can see we got a lower high, right? And that's, people talk about higher lows, higher highs, lower lows, lower highs, but with these Heikin-Ashi candles, this is the signal right here, and this is on the 2-day. So I did have an opportunity here to jump out, but the trouble is that, the price here, we got a pretty big range because it's a 3x fund. I'm down a few percent here, even after buying, let's see. Yeah, so this is kind of a funny thing because the weekly chart has crossed over here, but the 2-day chart hasn't given a signal yet. Anyway, I got kind of tripped up there. But you can see that these next few, or at least this next candle, is just not looking beautiful after the weekly crossover. And so you're looking for these events where there's no down wick, right? That's basically what you're looking at. But that is that's just an approach. I find it sometimes to be a little too restrictive to be playing completely off of the 4-hour. If you're feeling confident about something and just feel like it needs time, sometimes you just need to let it go. Although I would say if the 2-day or the weekly chart crosses over bearish, definitely jump out. But again, stop losses I think are a really useful tool if you're using them in conjunction with these candles. That's all I have to say. I know I've said a lot here, but that's about all I have to say for this.